Group. It's not quite 10 o'clock on Friday, the 25th of March here in New York. I wanted to talk to you today, pretty much an overview of where we are. You know, the title and the page is Gold and Silver Two-Way Streets. And that's pretty much what I want to talk about. You know, recently we had gold and silver rise to record prices, come off sharply, kind of come back a little bit. They've traded in a little bit of a consolidation range for a few days. We had said that we thought that the market could move sharply higher or lower out of that consolidated range, depending on what happened with the Ukrainian war. And what happened was that things got worse. The civilian casualties and the targeting of civilians got worse. There were a number of other problems, and the prices of gold and silver rose. They broke out of that range and moved higher. And we have been saying to our clients, yeah, we think that the prices are going to stay strong and move higher as long as the war, the Russian war in the Ukraine, is being prosecuted. As long as it's going on, there's there. Now, we've made the point that at some point there might be a resolution to the war or a clear path toward a resolution. And at that point, gold and silver prices could come off sharply, along with platinum and palladium prices. The last several days have been pretty pessimistic looking. So the idea of a resolution or a path to a resolution emerging seemed more remote, and gold and silver prices responded to that. We're seeing over the last 24 or 48 hours that suggest that maybe we move toward a resolution sooner. And if that emerges more publicly, you could see gold and silver coming off. We're still telling people play it from the long side. We love options, so stay long, but maybe buy some puts or a put spread below the market because at some point this could change. The things that we're seeing is, a Ukrainian counteroffensive. They sank a ship yesterday. They have taken back quite a bit of territory in and around Kiev. You're also seeing issues within the Russian military and within the hierarchy of the Russian political government. So there are some issues that could change the perspective and the course of the war relatively quickly. Hopefully that happens and we see the war move toward a conclusion. It's going to be very difficult to achieve that, but it is possible and it is probable. So when that happens, you could see gold, silver, platinum, palladium come off. The other big risk for precious metals focused on gold is the potential of Russia selling some of its gold to raise cash. It has $500 billion in foreign exchange reserves, but approximately 200 billion of that has been frozen in foreign banks. Another 200 billion of it appears to be frozen in banks that are not participating in sanctions, the People's Bank of China primarily, but also some other central banks, to remain nameless. And those central banks have not necessarily released that money, saying, well, yeah, it's your money and we ought to give it back and we're not imposing sanctions, but there are these international sanctions there. And the international sanctions are such that if we gave you your money back, converted it from yuan in our bank to rubles for you, or dollars is what they really want, we could run afoul of the sanctions. So we're not going to give you your money back. So yeah, you've got $500 billion, but you can't touch most of it. And I'll talk a little bit later about Russia's economy and political environment and stuff. So given that, and given that the Central Bank of Russia has 73 million ounces of gold, it may try to sell some gold to other central banks or to some bullion dealers and banks that would actually trade with them. in order to raise cash. And so that's a risk that's out there. Russia issued an ultimatum to Western Europe, or what it called unfriendly countries, that it wanted its oil and gas payments in rubles. Germany, which is perhaps the largest importer of Russian natural gas, said, we're not going to do that. We can't actually do that. And there's like, well, maybe we'll take gold. Well, you're not going to do that either. So, whereas the spineless Europeans have not imposed restrictions on importing and paying for oil and gas from Russia, Russia may actually put them into a position saying, fine, springtime's coming. So you might see a reduction there too. And that could also be a risk because, hey, desperate economies require desperate actions. You have 73 million ounces of gold for a reason. There are, as I've talked about in previous videos, there's probably about another 55 million ounces of gold that, at least in the past, was controlled by the Russian army. It probably is still controlled by the Russian army. The Russian army does not seem inclined to say, oh, the Russian government that's put us into this terrible bind needs money, let us give them some of our gold. So I don't think that gold gets mobilized right now. I think, it's a rainy day fund that's been there for decades. And it is raining on the Russian military right now, but I think if they're going to use the gold, they'll use it for themselves. And they probably won't use it now, but perhaps after the Ukraine war is resolved, some of that gold may come out into the market. So that's there. Prices can and will fall at some time. That's the message that I wanted to give today. Right now, we're saying we would stay long because the war is continuing, and you have to be a total fool to try to predict the outcome of a war at this stage in this war. Meanwhile, you have the rest of the world going on. Inflation continues to be a problem. It's gotten exacerbated by the war. Economic growth is having some stumbling efforts. We do think that you'll see very low GDP in the United States and probably in Europe for the first quarter, but going into the second, third, and fourth quarters, we think that you'll pick up. Interest rates are rising. They will continue to rise, but they're rising from a very low level to a less low level. We don't think that interest rates will rise so high as to cause major disruptions in the economy, the stock market, or the precious metals and commodities markets. You have to remember that right now, the percentage of investors holding cash and the amount or percentage of investor financial assets that's in cash is at the highest levels that it's been in many, many decades. There's an enormous amount of cash out there waiting to be invested or deployed. So there are strengths there. And those are private sector cash. That's not the Fed or the US Treasury. There also is a tremendous amount of bearish sentiment, sentiment indices for the stock market are showing very high levels of bearishness on the stock market, which is kind of strange, and we don't quite buy it. If you look at the big sell-off that we saw over the last month or so in the stock market, about half of that loss has been regained in the Dow, in the S&P, and even in the NASDAQ. So I think that the bearishness could flip back to more bullishness in the stock market. That said, you do have investors saying that they are extremely concerned or fearful at this point. So there are some issues that are still pro-gold and pro-silver in the global market beyond Ukraine. Our view had been before the war that gold and silver would sort of consolidate at recent high levels over the course of 2022. The war changed that and prices moved higher. We do think that when the war resolves, and that could be sooner or it could be later, and we really don't know how that resolution is going to be, the prices could come off, but we still see them consolidating. And I'll show you a chart in a second from our Gold Yearbook, which is coming out in a couple minutes, that sort of highlights that. But I wanted to talk a little bit first about Russia, a little bit more about Russia, its economy, politics, the ruble, stock market. The economy, it's funny, the IMF said, I think yesterday, that they think that the real GDP in the Russian economy could decline 35% this year. On a shorter term basis, you're looking at approximately a 40 to 50% decline just over the last several weeks in the Russian economy. So the Russian economy is suffering mightily because of the war and because of the sanctions imposed on various portions of the Russian economy and society as a result of this. I think the political situation is in flux, and we really don't know what's going on there. We do know that the Minister of Defense has disappeared for the last 14 days and has been gone. We have reports that about half of the hierarchy in the Russian government have been fired or replaced because they were dissenting to the war. We know that the polls in Russia are about 50% in support of the war and 50% against it. We've seen more than 20,000 people arrested protesting the war. We've seen evidence that the military was against starting the war, and it's grown more greatly in opposition. The potential of what analysts call the Caesar solution, that Putin is replaced and Russia backs out of the war, is probably growing in potential or potential probability because you have a lot of faith saving that has to happen, and Putin's not going to save face. Russia might save face, but Russia with Putin will have a more difficult time of extracting itself from this quagmire than Russia without Putin. So that has grown in probability, and the contingency planning that is characteristic of Soviet planning, which is still the way that the Russian government plans, is there. The ruble. I want to talk a little bit about the ruble, and I love show and tell. I've showed you guys these things before. This is a 5 ruble note from Tsarist Russia. So pre-1917, I think it was about 1909, 5 rubles backed in gold. It's a collector's item now. It's worth about $5 to $7 as a collectible. The Russian government, the Soviet government, after the Bolshevik Revolution, said, we're not going to pay you gold for our Tsarist notes. So 5 rubles, collectible for about $3 to $7. This is a 5 ruble coin from the Soviet era, looks like it's a 1989, so late in the Soviet era. This 5 ruble coin is worth about $1.50 to $10, depending on the grade, as a collectible. It is actually steel with a brass cladding put over it. And this is a post-Soviet 10 ruble note. I didn't have a 5 ruble Russian coin, but this is a post-Soviet Russian 5 ruble note that I picked up at some point in Moscow, and it's worth about 4 or 5 cents right now. So 120 years, a little over 100 years, 1917 to 2022, a little over 100 years, 3 governments, 3 sets of currencies, and they're all worthless. That's the ruble. Now, talk about the stock market in Moscow. It's been closed for weeks. They reopened it yesterday. When they reopened it, they said, okay, there's no short selling, and foreign investors could not sell shares that they had. The government, most of the trading Thursday and probably on Friday too, seemed to have been government agencies. But here's the interesting thing about the Moscow Stock Exchange. Foreign investors, mostly institutional investors, held more than 80% of the shares on the Moscow Exchange in the first half of last year. We don't know what it is right now, but 80% of the public equity shares in Moscow were held by foreigners. Of that 80%, the United States and Canada had more than half of it, and they had 22%, and other European countries had 21%. That's actually not all that unusual. You know, more than half of the pension fund monies are U.S. pension funds. A lot of it's held offshore. There's certain tax advantages there, and a lot of it's just investments. But you know, when you start talking about, well, we're really hurting the Russian economy, yeah, but 80% of the public shares in Russia are owned by foreigners, and half of that is owned by Americans. So it's a world where you have to shoot yourself in the foot because of somebody going to war elsewhere. Oil and gas, you know, it's going to be interesting to see what happens. Will the Gazprom listen to Mr. Putin and insist on ruble payments for their gas exports to Europe? Europe really doesn't have the rubles to pay them. So you could see oil and gas exports cut. There will be a move away from Russian oil and gas, that's clear. It's going to be a long-term move. You know, the putting in liquid natural gas ports in Europe is going to take 3 to 5 years. And as is the case in the United States, there's a lot of NIMBY. There are a lot of people say, yes, we should be importing liquefied natural gas from North America, Qatar, and other places, but don't put the port port for these imports near me. So it's going to take at least 3 to 5 years to start making that move. The world will still be dependent on and reliant on Russian oil and gas exports, but there's a clear trend away from that. Qatar, by the way, also this week said that they would be increasing, they would be amenable to sharply increasing their exports of natural gas to Europe, but there's no way to get it there efficiently at this point. So it's a nice sentiment that won't be reflected in reality right now. And then it goes back to that gold, 73 million ounces in central bank gold, which represents a much larger portion of total monetary reserves now that a large portion of their foreign exchange reserves have been frozen and probably will remain frozen for a long time because there'll be claims on those monies for reparations and reconstruction in the Ukraine. So Russia may well find out itself selling gold. And a little bit of history on the Russian gold sales. They had a lot of gold during the Soviet era. There was a lot of gold sold in the early post-Soviet period, probably more than the government wanted to sell. The government realized that its gold, diamonds, platinum, palladium, rhodium reserves, above ground reserves, had been sold off in inappropriate ways, 1992 to 1996. So they stepped in and they cracked down and they stopped those exports and sales, and they said, we want to rebuild these inventories. They had about 17 billion in foreign exchange reserves at the time. The Russian economy officially was contracting at 10% per year real GDP in the late 1990s. If you went to Moscow or other parts of Russia, you saw the oligarchs living high and tremendous construction, tremendous poverty for most Russians, but also tremendous construction and wealth on the part of the oligarchs and their associates. And when Putin came to power, he said, okay, here's the deal. You guys stole these state corporations and rigged bids. You haven't paid taxes for 10 years. The economy is contracting at 10% officially, but you guys are growing leaps and bounds. I will not prosecute you for stealing these companies and not paying taxes for 10 years if you do two things: stay out of politics and start paying taxes. And within a couple of years, The real economy, as reported to the government through its tax receipts, was growing at 10% per year, along with the unofficial estimates of it. And almost all of those oligarchs stayed out of power, out of politics. Mikhail Khodorkovsky didn't stay out of politics. He was the second largest funder of opposition candidates in the Duma when he was arrested for stealing an oil company and not paying taxes for 10 years. But that was the arc there. The gold, they wanted to rebuild. They didn't have foreign exchange reserves. The oil price started rising 2002, and it moved very steadily. I showed you a price chart a few months ago about the way OPEC managed to take oil from $10 a barrel up to about $100 a barrel. Then there was a spike up to 140 in 2008, I believe. But you saw a tremendous increase in oil and gas prices in the period 2002 to 2007. And that led to a big increase in Russian foreign exchange inflows, capital flows into the country, mostly in dollars. And they started using those dollars to rebuild their gold. And they went from maybe 13 million ounces of official reserves to 73 million ounces over the course of, say, from 2003, 2004, up until this year. So there is that gold, and it could be mobilized. The idea that Russia will have foreign exchange inflows that it can convert into gold is highly unlikely for a while. So Russian purchases of gold for central bank reserves probably will not resume for a while, because any inflow of foreign exchange is going to be needed to help survive the Russian economy survive. So that's sort of the state of play as we go into the weekend. This is updated gold investment demand chart and prices. The red line is price changes. And you can see when investors buy more than 20 million ounces of gold in a year, the price of gold tends to rise. And when they buy less than 20 million ounces, those lighter blue bars, the gold price tends to fall. This is from our Gold Yearbook, which we will be releasing on April 6th. So I'm giving you a little bit of a preview of our latest thinking. And I want to point out that you see this very big spike to, the third highest, fourth highest level of gold purchases on a physical net investment demand in 2020. And that's when the gold price rose very sharply up to $2,000. Last year, gold demand was still very high by a historic standard, but it was down around 28, 27 million ounces, if I remember correctly. And the gold price rose 1.7%. Still strong investment demand, but not as strong as it was in 2020 at the turn in the market. And the gold price responded accordingly. Very big increase at 40 million ounces, less dynamic increase, like 1.7%, when it's less than 30 million. We have it rising a little bit this year, obviously subject to change given the state of play with the Russian invasion of Ukraine. But we have it staying strong for all those reasons I just talked about, but not going back up to 40 million ounces. This will be a key chart in our Gold Yearbook. Our Gold Yearbook probably will be about 200 pages long. We will be having a briefing, which is open to the public online on April 6th. You can register to plug into that briefing on April 6th at this website. You can pre-order the Gold Yearbook and get it in PDF form as of April 6th at this other website. So we'll do that. We'll then turn our attention to the Silver Yearbook, update it, and release it, or targeting May 10th. And then PGMs will come later in the year. As always, we have a retail investor program. We are looking to add a bolt-on for options, trying to struggle with what we can do. We are a CFTC NFA registered commodities trading advisor, which permits us to provide those kinds of services to accredited investors and qualified eligible participants in the market. We're not authorized to provide commodity trading advisory services to non-accredited investors at this point, but we can provide them some of our advisory services through, for example, a newsletter. So we're working on bolting on an options advisory program to the retail investment program. You can read about all of this stuff at our website and download a lot of free things and order yearbooks and other reports. Thank you for your attention, and we'll talk to you next week.